Welcome to today's stock analysis, where we revisit Novo Nordisk and Eli Lilly, two medical giants renowned for their breakthroughs in diabetes and obesity treatment. The past year unfolded with intensity, fueled by the hype surrounding their groundbreaking obesity treatments, Wegovy and Zepbound. Are these companies overvalued or currently trading at fair values? Share your insights in the comments below. And now, buckle up and let's jump into the intricate world of stock analysis and discover what these insights reveal about today's stocks. We've seamlessly integrated the ticker symbols for Novo Nordisk and Eli Lilly's into our spreadsheet, automatically importing the relevant stock data. Novo Nordisk is trading at both the Danish and US stock exchange, but here we will use the ticker for the US stock listing. Examining the 365-day graph, we observe a fluctuating upward trajectory for both stocks over the past year. Novo Nordisk has gained approximately 88%, while Eli Lilly has gained close to an impressive 143%. Shifting our focus to valuations in comparison to target prices, Novo Nordisk appears to be approximately 4% above the mean analyst target price, while Eli Lilly is trading 4% under the analyst target price. Both stocks are thereby trading very close to their analyst target prices. Now, let's delve into a more detailed analysis of the intrinsic values for these two stocks, utilizing the 5 distinct intrinsic valuation models embedded in this spreadsheet. This exploration will provide a comprehensive understanding of Novo Nordisk and Eli Lilly's intrinsic valuations. Our initial stop in the realm of intrinsic valuation brings us to Graham's revised valuation model, a creation of the legendary Benjamin Graham. This model enables us to determine intrinsic value based on 3 key inputs: earnings per share, the anticipated growth of the company, and the current yield of a AAA bond. Fortunately, our automated spreadsheet streamlines the process, requiring only the addition of the company's projected growth, readily available on platforms like Yahoo Finance. Both Novo Nordisk and Eli Lilly have high estimated growth projections for the next 5 years. Upon incorporating the projected growth for Novo Nordisk into this model, the intrinsic value calculation yields $66.62. This indicates that Novo Nordisk's intrinsic value is approximately 50% below its current stock price. Applying the same methodology to Eli Lilly, the intrinsic value computation results as $305.62, revealing a substantial difference of -60% relative to the current stock price. Both stocks thereby seem to be trading at a value significantly above their intrinsic values. Moving on to the next valuation model, we explore the Peter Lynch dividend adjusted fair value model. In this method, the Peter Lynch fair value is determined by adding the earnings growth rate and the dividend yield, and then dividing the result by the price-to-earnings ratio. The output is a value either above or below 1, where a value below 1 suggests an overvalued stock, while a value above 1 implies an undervalued stock. Upon applying this model to Novo Nordisk and Eli Lilly, we get two very similar results. Both stocks have a Peter Lynch fair value close to 0.40, indicating that they are trading at a stock price over their intrinsic value. To refine this assessment, we perform additional calculations, although I won't delve into the specifics in this video, to derive a more tangible fair stock price. For Novo Nordisk, this computation yields a fair stock price of $55.97, approximately 60% under its current stock price. On the other hand, Eli Lilly's fair stock price is calculated at $292.01, also 60% under its current stock price. Now, let's delve into the comparable company analysis, also known as the multiples valuation model. This approach involves identifying companies similar to the one under scrutiny and utilizing their price-to-earnings ratios to calculate intrinsic value by multiplying with the company's earnings per share. In our analysis, I've included comparable companies for both Novo Nordisk and Eli Lilly. Focusing on Novo Nordisk, the intrinsic value derived from this model stands at $153, a 15% above the current stock price. Shifting our attention to Eli Lilly, the calculated intrinsic value is $241.50, a substantial 68% under its current stock price. This comparison unveils interesting dynamics, suggesting that Novo Nordisk is currently trading at a valuation in line with its industry peers, while Eli Lilly is trading at value far above its industry peers. As we continue to explore diverse intrinsic valuation models, we aim to paint a comprehensive picture of the true worth of these companies in the market. Now, let's explore the dividend discount model, a method that delves into a company's dividend payouts over recent years. We calculate an average dividend growth rate, and this, along with the discount rate, is used to determine the intrinsic value of the stock. The spreadsheet also offers the flexibility to input a custom dividend growth rate, allowing for adjustments to be more conservative, if desired. Both Novo Nordisk and Eli Lilly pay dividends to their shareholders, which allows us to use this model on the two stocks. For Novo Nordisk, we leverage the yearly dividend information available on Yahoo Finance. By incorporating the total yearly payouts and setting the payout interval to yearly, we obtain an average dividend growth rate of 35%. This is probably not a viable growth rate for the next several years, so we therefore choose a more conservative growth rate of 7.75%. Utilizing a discount rate of 8.5%, the calculated intrinsic value for Novo Nordisk comes in at $149.41. For Eli Lilly, a company with consistent quarterly dividend payouts, we leverage the dividend information available on Yahoo Finance. By incorporating the quarterly payouts and setting the payout interval to quarterly, we obtain an average dividend growth rate of 14.87%. Again, we choose a more conservative dividend growth rate of 7.5%. Utilizing a discount rate of 8.5%, the calculated intrinsic value for Eli Lilly comes in at $559, under its current stock price. Our final stop on this intrinsic value journey brings us to the discounted cash flow model. This model values a stock by estimating its future free cash flows, discounting them to present value using a chosen discount rate. It then factors in cash and cash equivalents, subtract total debt, and divides the result by shares outstanding to determine the intrinsic stock value per share. For Novo Nordisk, we can source the necessary data from Yahoo Finance, including cash and cash equivalents, total debt, shares outstanding, and free cash flow data available online. When we integrate this data into the model and choose a discount rate of 8.5, the intrinsic value calculated stands at $139. This is in line with the current stock price. Applying the same methodology to Eli Lilly, the model yields an intrinsic value of $518, 32% below the current stock price. These diverse intrinsic valuation models provide us with a comprehensive perspective on the intrinsic values of Novo Nordisk and Eli Lilly, offering valuable insights for investors seeking a deeper understanding of these stocks in the market. In the summary section, we've assessed and compiled all calculated intrinsic values for Novo Nordisk and Eli Lilly, making strategic decisions on which valuation models to include in the final calculation. As the calculated intrinsic values vary and there is not a specific outlier, we include them all in the final calculation to reach a representative average intrinsic value. Doing so, the mean intrinsic value for Novo Nordisk is $112.86, which is 15% below the current stock price. Acknowledging the inherent uncertainties, a margin of safety of 20% is incorporated, leading to an acceptable stock price of $90.29. In the case of Eli Lilly, we get an intrinsic value of $383.18, close to half of the current stock price. By applying a margin of safety of 20%, the final acceptable buying price hovers at only $306.54. In conclusion, Novo Nordisk's average intrinsic value, including a margin of safety, is below its current stock price. Eli Lilly is trading at a stock price 50% above its intrinsic valuation. Based upon this data, none of the stocks are trading at a favorable price. However, if we should choose one, then Novo Nordisk emerges as the more favorable option of the two stocks and could be a keeper for the long run, while Eli Lilly is currently trading at a premium. If you found value in this video, don't forget to hit the like button and subscribe. It truly goes a long way in supporting our small channel. Got a specific stock in mind for analysis? Share it in the comments below. And if you want to harness these valuation models yourself, check out the intrinsic valuation tool featured in this analysis, available exclusively on our Patreon page. There, you'll also find a comprehensive valuation list for all stocks analyzed on this channel. For your convenience, the link to the page is in the video description below. Happy investing! Now, a crucial disclaimer: I am not a professional financial advisor. The stock analysis presented on this YouTube channel is intended for informational purposes only and should not be construed as financial advice or a recommendation to buy or sell any stocks. Until next time, take care and happy investing.